In this video, we would be covering the basics of anti-money laundering. We will delve into the world of financial crimes and money laundering. We'll explore what constitutes proceeds of crime, examine the distinction between tax evasion and proceeds of crime, and take a closer look at the efforts made by global organizations, like FATF, to combat these illicit activities. We will also look at different ways people launder money and what financial institutions need to do to prevent and detect money laundering. We will try to understand KYC, CDD, EDD, and sanctions screening. And finally, try to understand what is transaction monitoring and suspicious activity report. Wherever government is able to identify or detect criminal activities, it will stop it and take legal actions on individuals and corporations involved. It will also identify, seize, and confiscate the money generated through criminal activities, which is called proceeds of crime. Criminal activities could be drug dealing, extortion, prostitution, gambling, human trafficking, and more. But despite this, criminal activities do go on, and it is important to make sure that financial institutions do not get misused to launder money. However, criminals do want to somehow make proceeds of crime appear legitimate, because only then they can use it for buying assets, spending on luxury, and other purposes. Therefore, government mandates financial institutions to implement strong AML program to both prevent and detect money laundering. Difference between tax evasion and proceeds of crime. In case of tax evasion, the activity through which money is being made is not criminal or illegal. However, tax is being evaded by illegal means. In case of proceeds of crime, the activity itself is criminal activity and punishable by law. However, both are illegal and have consequences, albeit of different degree or levels. Importance of AML program has increased very significantly because some of this money has been used to finance terrorist activities in the past. The Financial Action Task Force, FATF, is an intergovernmental organization established in 1989. It was created with the aim of combating money laundering, terrorist financing, and other threats to the integrity of the international financial system. FATF sets international standards and promotes effective implementation of legal, regulatory, and operational measures to counter these threats. Individual nations adopt these recommendations and form their own laws to implement them. The organization also conducts assessments of countries' compliance with these recommendations and identifies jurisdictions that have deficiencies in their AML-CTF regimes. Now, what is money laundering? In money laundering, the main aim is to disguise the illegal origin of funds. This is mainly done through three-step process: placement, layering, integration. Placement is the initial stage of money laundering, where dirty or illicit funds are introduced into the legitimate financial system. Layering is done by creating complex layers of financial transactions to further conceal the origin of the illicit funds. It is mainly to create confusion and obfuscate the money trail. Integration is the final stage in money laundering. At this point, the cleaned funds are reintroduced into the economy in a way that makes them appear legitimate, typically through investments or purchases of assets. Some of the ways through which people or corporations launder money are: structuring or smurfing. Structuring involves breaking down a large financial transaction into smaller, less suspicious transactions. The purpose of structuring is to avoid the threshold that triggers mandatory reporting to regulatory authorities. Smurfing involves using multiple individuals to conduct these transactions, thereby spreading out the activity and making it harder to detect. Shell companies. A shell company is a legally registered entity with little to no actual business operations. It can be used for money laundering to conceal the origins of illicit funds through a series of complex transactions. While shell companies themselves are not inherently illegal, their use for illicit purposes, such as money laundering or fraud, is against the law. Front companies. These entities are created to give the appearance of legitimate business operations while actually serving as a cover for illegal or unethical practices. They will have minimal legitimate activity to maintain appearances. The primary purpose of a front company is to provide a front of legitimacy to activities that are typically illegal, unethical, or clandestine. Trade-based money laundering typically involves inflating or deflating the value of goods or services being traded, misrepresenting the quantity or quality of goods, or even engaging in fictitious trade transactions. Real estate transactions are also used to launder money by overvaluing or undervaluing properties in the transaction. An offshore account is a bank account located in a foreign country, typically in a jurisdiction known for its favorable financial regulations, privacy laws, and low or zero tax rates. Offshore accounts can be used to conceal the true ownership of assets and income. Individuals engaging in money laundering may use offshore accounts to deposit illicit funds, transfer funds across borders to obscure the source, use nominee directors or shareholders to further hide the true ownership. Cryptocurrencies bring potential risks related to money laundering due to their pseudonymous nature and decentralized nature. They also provide ability to transfer large sums of money quickly across borders. Gambling facilities can be misused for money laundering because of large volumes of cash that flow through them and the potential for anonymity. AML regulation requires financial institutions to have a strong AML program to prevent and detect money laundering. Financial institutions are required to perform KYC and CDD before onboarding any new customer. In some cases, they are required to perform EDD. KYC stands for Know Your Customer, and it is a process to verify and confirm the identity of customer. Customer could be individuals or companies. KYC requires collecting information like name, date of birth, address, and official identification documents, for example passport, driver's license, to clearly establish the identity and address of the customer. CDD is customer due diligence and is part of KYC process. It involves assessing the risk associated with a customer based on their profile, nature of business, and the potential for money laundering or other illicit activities. CDD helps financial institutions to categorize their customers based on their risk level. This categorization determines the level of scrutiny and monitoring required. EDD stands for Enhanced Due Diligence. For high-risk customers, enhanced due diligence is performed, and it involves deeper levels of scrutiny and monitoring. KYC needs to be performed periodically, which would vary depending on the risk profile of the customer. Sanctions screening is a process to identify and prevent transactions or business dealings with individuals, entities, or countries that are subject to economic sanctions. Economic sanctions are measures imposed by governments or international bodies to restrict or prohibit certain types of economic activity with specific individuals, companies, or countries. Financial institutions are required to perform sanctions screening while onboarding a new customer as part of KYC process, during periodic review of KYC process, and also as part of transaction monitoring to ensure that customers are not transacting with individuals or entities present in the sanction list. Transaction monitoring means systematically reviewing and analyzing customer transactions for potential signs of suspicious activity. The primary goal of transaction monitoring is to identify unusual or potentially suspicious patterns of behavior that may indicate money laundering, terrorist financing, or other illicit activities. Transaction monitoring is done through IT platform, which goes through customer transactions and flags of suspicious transactions based on predefined models or algorithms. These flagged-off transactions are then investigated by financial institutions' compliance team and determined which of them are false alarm and which are truly appearing suspicious. Financial institution then prepares the suspicious activity report and submits it to the AML regulator of that country. So while onboarding a new customer, financial institutions are required to take steps to prevent money laundering by performing KYC, CDD, DD, and sanction screening. They are also required to monitor customer transactions for detecting potential suspicious activities. Thus, they are required to take measures to both prevent money laundering as well as to detect it. AML regulation requires financial institutions to have a dedicated compliance officer and a dedicated AML program. Financial institutions are also required to have training programs to train their staff and increase the awareness of AML program. Thus, AML program consists of both preventive measures as well as detection capabilities. KYC CDD, EDD, and sanctions screening help in preventing money laundering, as financial institutions filters out potential bad elements here. Transaction monitoring, sanctions screening of transactions, and suspicious activity reporting are for detecting money laundering by filtering out suspicious transactions and reporting them to regulatory authority. Thus you can see here that all types of financial institutions submit suspicious activity report to the regulator of the country. So regulator not only gets suspicious banking transactions across all banks, but also from share market transactions, insurance transactions, real estate transactions, and so on. Thus it helps in thorough investigation of money laundering cases. Nowadays newer businesses and industries are getting included in AML programs, like jewelry and diamond business, gambling etc., which are required to follow AML guidelines. Every country defines its AML regulations which are in line with FATF recommendations, for example PMLA, Prevention of Money Laundering Act in India, Anti-Money Laundering Directive in Europe, and Bank Secrecy Act, BSA, in United States. Every country has a dedicated regulatory body to oversee financial institutions for AML compliance, for example, FinCEN in USA, FIU in India, and FCA in UK. Regulatory body has its own transaction monitoring and case management system. All the suspicious activity reports submitted by various financial institutions get stored in a repository so that more thorough investigations across all financial institutions can be performed. Finally, what is the difference between fraud and money laundering? In fraud, the money involved is legitimate, whereas in money laundering, it is the proceeds of crime. In fraud, you want to detect it before transaction gets processed and prevent it whenever possible. So you need real-time transaction monitoring system. In money laundering, you will detect it mostly after the transaction has happened. However, both are illegal and are considered financial crime. This brings us to the end of this video. Congratulations! Thank you for watching this video. I hope you now have better understanding of anti-money laundering. Please share your feedback in the comments sections. Have a nice day.